Good afternoon, everybody, on April 19th, a Monday. Hope you had a great weekend. This is the last chapter we're going to go over in our course here, ACC 110. Hopefully, we can have a good test review next week. And you know, I'm available just about any time for tutoring or ad hoc one-on-one type work. So we're here for you, okay? So let's see what we have going here. Chapter 9 is the last chapter we are going to cover. Chapter 9. And let me make sure that you can see chapter 9, because I'm not sure if I shared it. Chapter 9. Uh-huh. Do you see it now? I hope so. Otherwise, I'm going to look like an idiot in about 45 minutes. So let me set this up the way I like. Off we go. Chapter 8 was all about the employee taxes. Employee taxes, those paid by the worker. That is your federal and state income tax and your FICA, basically. The employer also pays taxes. The employer pays taxes. And we need to know how to process those taxes and what they are. So what we're looking at here is FICA, which is not new to you, Federal Insurance Contributions Act. That was the 7.65 total. That was the 6.2% for Social Security and the 1.45% for Medicare. In other words, you youngsters are paying for my pension, if you will, my Social Security and my health benefits right now. Like future generations will be paying for you. The employer must pay exactly dollar to dollar what the employee paid. So that's a pretty easy one to remember, huh? Whatever the employee paid for Social Security and Medicare, the company must match. And they work along the same exact limits. Then you have the two unemployment taxes, federal unemployment taxes, state unemployment taxes. These are paid only by the company. The employer does not, the employee does not pay these. The employer does, the company. And obviously, these taxes add substantially to the cost of having employees, because whatever you paid in FICA, the employee paid, plus he had to pay these other things. Employer FIC taxes. Both the employer and employee pay taxes, and they pay an equal share. You both pay the same amount. And they're showing you the percentages, which you're not going to have to worry about. And the amount of earnings subject to Social Security tax, you're going to get that from your payroll register. Your payroll register. Let's see what we have here. These are called earnings. Earnings, and these are the taxable earnings. So here you have a person here, James Gruder. He made $760 regular. Then he worked some overtime, $900. That brought his year-to-date up to $43,400. Now, how much of that $900 is subject to unemployment compensation? The answer is zero, because you're going to learn shortly that after an employee earns $7,000, the employer no longer has to pay. So now we have to look at how much is taxable for Social Security. $900. All of it is taxable. All of it. Same thing with everybody else on here except the top guy. Sarah Cadron, she earned $2,060 this week. That put her over the $128,400 limit. So she earned $2,060. Of that amount, only $1,060 is eligible for the tax. And this is the tricky part. Understanding that once you hit $128,400, you are only going to pay the tax on up to that $128,400. So she had before this, now she has a cumulative of $129,400, and we just subtract out to figure out what the 1060 number came from. Cumulative total, prior total current earnings, earnings below 7,000, earnings below 128,400. Individuals who run their own business have to pay self-employment tax. We don't get into this too much, but essentially you run your own business, you have to pay double the Social Security. You're gonna have to pay the 7.65 times 2. And that's what they're talking about here. Self-employment rates are double the Social Security and Medicare rates. Not too much for us to worry about there. Here we go, FUTA tax. FUTA, Federal Unemployment Tax Act. Federal unemployment taxes. Levied only on the employer. It does not get deducted from anybody's paycheck. This is one of the 3 taxes paid only by the employer, not deducted from the payroll, from the employee's earnings. And this is the funding, like I said, for my Social Security. And in your book, the rate is 6%. That turns out to be 0.006. Got to move that decimal over 2 points, right, to turn it into a decimal. So 0.006 is the correct way to read that as a percentage. And it's only up to $7,000. So 0.006 times $7,000, you're going to find out is 42 bucks. That's the most any employer has to pay for federal unemployment insurance. And that 0.006 decimal number has been the same for quite a while. It very rarely changes. I don't ever remember changing. Employers are allowed a credit up to 5.4 for participation in state unemployment, but the effective rate is essentially 0.6. SUTA, state unemployment taxes levied on employees in most states, and these monies are used to pay unemployment benefits. Now, unlike the federal unemployment tax, state rates bounce all over the place. State rates bounce all over the place. They vary from state to state. And in this tax, the SUTA rate is 5.4%. We're just going to use that as our baseline. And once again, it's 5.4% of the first 7,000 of employee earnings. It doesn't go any more complicated than that. So 7,000 times 0.054. I think that's, I don't want to guess at the number, but that answer is the maximum that would come out. Let me do the math right here, since I have my trusty calculator here. So that's 0.054 times 7. Yeah, $378 is the most the employer would have to pay on that. Now, here's something important to understand. Most states have an experience rating system to encourage employers to provide regular employment. If an employer has very few former employees collecting unemployment, the employer qualifies for a lower state unemployment tax rate. So state unemployment taxes are controllable. If you have the type of company where you've got long-term employees and very, very little turnover, people don't quit every day in your company, you'll be able to knock that 5.4% down to a much lower rate and have that kind of savings. The full credit rate is still allowed even if the employer pays a lower rate. But the key thing here is you can control the state unemployment. Now, you go to your fast food places where you have students who work a summer sometimes, and then they leave, and there's a great deal of turnover. They would have a very high unemployment rate. Employer taxes, take a look at this grid. This is an important grid, huh? Using information from the payroll register, here's how we calculate the taxes. Social Security up to $128,400 is multiplied by 0.062. Medicare taxable earnings In this case here, this person went over the limit by $1,000. You can tell because the 6897 is Medicare and this is Social Security. There's no limit on Medicare. Social Security times the 062, 365.61. This employer has to match the employee. Same thing with the Medicare, which has no limit. So the entire salary this week of 6897 times the famous 0.0145 equals $100.01. Again, matched by the employer. Let's take a look here. The earnings that were eligible, this is not the tax to 360. These are the earnings that are still eligible for the tax. Perhaps you had one employee who was $360 below the 7,000 threshold. Well, this person went over this month, so it's only 360 times 0.006, 216, and the unemployment, same number. Okay. So what are the taxes the employer pays? Both sides of FICA plus the state and federal. These are expenses to the employer. They have nothing to do with the employee's pocketbook. Account for the payroll tax expense. Well, this is a long-winded screen here, but I'll summarize it, hopefully in a clear way. First thing you got to know is obtain the total earnings and the taxable earnings. The taxable earnings are not the same as the total earnings. They could be very different. Compute the amount of Social Security. Compute the amount of employer's Social Security. You multiply the taxable income by 6.2, 1.45 for Medicare, 0.6, 0.054. So I guess the slide wasn't as complicated as I thought it was going to be. All they're telling you is find out what the taxable income is. It can be different between Social Security and Medicare. It'll always be the same for FUTA and SUTA, okay? So let's see what we did here. Excuse me. Try it now. There we go. Look at our journal entry. Look at the journal entry. We had a certain amount of payroll times 0.062. Medicare was 0.0145. FUTA was 0.006 on our book, and SUTA was 5.4%. State unemployment, federal unemployment. Medicare, that's my health insurance you're paying. Social Security, that's my pension you're paying. So you just multiply the numbers out. And here they are right here. I'm assuming they're using the same numbers. 365, 100.01. And there's your journal entry. That's not too tough. Not too tough. You understand that every one of these is money the company now owes. All four of these things are liabilities. And we're going to call them such: Social Security payable, Medicare payable, FUTA, and SUTA payable. Add them up, and that becomes your total payroll tax expense. There's no reason to break out the payroll tax expense into anything other than a lump sum total, okay? I've seen companies that do that, but typically you don't need to do anything except add up your credits, and that's your payroll tax expense, okay? That's our journal entry. Journal entry. And here they are. They're introducing the new items you've seen. We now have a new expense you've not seen before: payroll tax expenses. And they consist of, every penny of this has to be a liability somewhere. And it is. We have to pay it to Social Security, Medicare, FUTA, and SUTA. So not too tough so far, I don't think. What are the accounts used in payroll tax accounting? Well, we already saw that on the journal entry. Payroll tax expense, just add up all the taxes. Social Security and Medicare, credited when taxes imposed on employer or withheld from employees. Same thing. Same thing with FUTA and SUTA. As soon as it comes out of the employee's pocket, well, you know, as the boss, you have to pay the same exact amount. And what they're going to show you here What they're going to show you here is that, oh, I'm so sorry, guys. Uh-oh. I just want to move this over a little bit. Okay. The total cost of an employee. Employers love to hand this out. I bet you've gotten this at one time or another in your career. Maybe you didn't look at it or really worry about it. But what the employer is telling you here is, yeah, I'm paying you $26,000 a year. And you want a raise to go up to 28,000? No way. Because you also cost me 1612 in Social Security tax. You cost me 377 here on the Medicare, and same thing with the state and federal. So I'm already paying you $28,409. And you got the nerve to come in here and say you want to get a raise to 29? Well, you're practically there already. It just shows you, though, that the employer pays a lot more for the payroll requirements than the employee does. Describe employer reporting payment responsibilities. These vary depending on the amounts. I think it depends on how you set yourself up with the IRS. Federal income tax withholding, those are the ones that came out of the employee pocket. They are going to be paid to the IRS, I guess, to the federal government, and it's going to be done on Form 941. Form 941. FUTA is also paid to the federal government, but we're going to use a different form, the Form 940. SUTA taxes, state unemployment tax. Here in California, it's the DE3 form that all employers must file. I'm not an expert on this. I used to be many years when I was actually working for a living, but it depends on the amount of the payroll. You might have to pay it every month, or you can do it quarterly. Employee wage and tax statement, the W-2. Remember the W-2 that you filled out when you began? That's what's going to drive the federal and state income taxes. Summary of employee wages. Yep, that's the W-3. That's just the cover sheet for all the W-2s that you print out. And the I-9, where you have to prove that you are an American citizen. Federal income tax. Okay, now we're going to start talking about the different taxes that we all have to pay. Federal income tax withholding. The employer does not pay federal income tax nor state income tax. That is paid strictly by the employee only, workers only. But the company has the responsibility and the duty to turn that money over to Uncle Sam. So the employer has to know when to make those payments, and they're required to use some kind of electronic funds transfer system, and they put it on Form 941, okay? So the federal income taxes go on Form 941. And here are some of the rules of deposit. Remember I talked a little bit earlier about I wasn't sure when you make these payments? Well, it depends on the amount. Less than $2,500 at the end of the current quarter, you can pay at the end of the month following the quarter. But if you go up to $50,000, you have to pay within 15 days. And more than that, you have to deposit twice a week, and 100 more, you have to get that money in much quicker in one day, okay? So a question on the test might say something like true or false. The money's paid, the money turned over to the state, turned over to the feds with your 941 is always paid on the end of the month. And the answer would be false. There's 4 different possibilities. The look back period is it's nothing we're going to worry about in this class here, okay? The look back period is the what they do. I'm trying to say this properly. The feds look at your past deductions, and if they think you've not been taking enough out over the last couple of years, they're going to look back. They're going to look back on those numbers, and they're going to say, look, you've been using us as a tax-free loan for a long time, an interest-free loan company. Now I want you to start paying back much more frequently. So what typically happens if you've been claiming married 9 and not paying much, and then at the end of the year, you're paying a big amount to the feds, they don't like that. They want you to come back at the end of the year pretty much even to what you're going to pay them versus what was taken out. Okay. Okay. Who do we make the president taxes to? We make them out to the United States federal government. Must be EFT, electronic funds transfer. Every deposit requires a journal entry. Guess what? That's going to be a debit to the liabilities and a credit to cash. So let's take a peek here. Who receives these 3 taxes? Federal government, federal government, federal government. So you debit your 3 liabilities. These liabilities are gone. And now we add them up, and that's the amount of the check we would pay. Okay. Let's look at the 941, not in any great detail. There's a very, very good payroll class that's taught here by Barbara. I forget her last name, Barbara. I just can't remember her last name. Nice lady. And you can learn all you want about the 941s. We're just going to give you an overview here. The 941 is filled out quarterly. It's due at the end of these 4 months, okay? And what you're going to report on here is how much was withheld from employees for federal income tax and how much was withheld for FICA. FICA meaning Social Security and Medicare. And you have to show that you are matching the employee Social Security and Medicare. And I'll just blow this up real quick. This is not a hard form to do. And again, you're not going to have to worry about it here. But let's just take a look at it. 941, the name of the company and the address and all other kinds of information. And then what quarter are you reporting? This company is saying we're reporting for the first quarter. So this thing is due April 30th. And you're supposed to put the number of employees you have. This is a small company, 8 employees. 8 employees. And their total salaries for the first quarter were $81,900. You withheld $6,552 for federal taxes. Of this $81,900, the entire amount was still eligible for Social Security. So you multiply it times 1.24, and you multiply the Medicare by 0.029. The 1.24 is the 6.2% for Social Security, double. 6.2 times 2. Same thing with the 0.009. The 0.0145 becomes 0.009 when you double it up, okay? So you multiply these out, and you now have the amount that the employee paid and employer is going to pay. Same thing with the Medicare. You add these up, and you've got a total of $12,530.70. You add it to the federal income taxes, and there you go. You're pretty much done with this form. Now, there can be all kinds of different entries. I like that they have a quarter's adjustment for fractions of cents. Gives you a chance to round up or down. But I think that's really quite enough on this form for purposes of our class. You just report what was taken out of the employee's paychecks for federal tax and for FICA, and you present it on this form here. Not too bad. And this is the second page. I'll show you the second page. This is the key one, I guess. Page 2. If you are a monthly depositor, you got to put the numbers back on here. So 190270, that better equal what was on the front page of this report. And it certainly does. There's the 190270 total, okay? Uh-oh, we got the gardener coming. Futa taxes. Futa. I can outshout the gardener. That would be rude. Let me tell this guy to shut up, okay? Hold on. Okay. All right, I've come back. I straightened that guy right out. So Futa taxes. They're not going to be on the 941. They're going to be on your 940. And we just debit the liability and make the payments. Let's take a look at the 940. It looks quite a lot like the 941. Come on now, here we go. Zooming the modern way. It looks similar to the 941. But here it's the total payments to all employees. And then more importantly, the amount of payments, the amount of employee payroll over 7,000. So this company has X amount of employees, and many of them have already gone over 7,000 and many have not. So the amount that is paid over the 128.4, not the 128.4, but the 7,000 is the 280. What's left is the amount of taxable wages to pay. You multiply it by 0.06. This one is not too difficult. Guess what? One of the payments is going to go to the state unemployment. Here we debit that payable, which we established earlier, and we credit cash. Form DE3 in the state of California. And now they're talking about some forms, and I'll try to go through this with you without putting us all to sleep. But the Form W-2, you all filled that out when you went to work. You may not remember, but your boss handed you some paperwork to fill out. And among the documents was the W-2. And you put down the number of allowances you're claiming. You put down whether you're single or married or head of household in your name, and everything is signed off. And the employer at the end of the year is going to send a copy of this to the employee. I'm sorry. I'm mixing up W-4 with the W-2. Sorry about that. W-2. This is the form you get in the mail at the end of the year. It shows the total amount of wages paid and taxes withheld from the preceding taxable year. So you open up your mail one February evening or afternoon, and there's the W-2. It shows you how much money you made. And forgive me for talking about the W-4 while I was involved with the W-2. So you've seen this before. Notice the total wages paid, the total federal income tax withheld, Social Security withheld. The first column where you see the odd numbers, 1, 3, 5, those are various taxable levels of income. In this case, they happen to be all the same. The last column with the even numbers, 2, 4, 6, that is the amount that was withheld from your paycheck. Withheld from the paycheck. The Form W-3, this is just a cumulative W-2. You're not going to see this. This is no business of yours. It's the company summary page of the W-2s. Just imagine that you added up all the W-2s to get the totals. Well, that's the W-3. And this is due by the end of February, okay? The W-2 to the employees is due at the end of January. But here's when the companies have to finally send in the W-3. It's just a summary of all the W-2s. And here's a look at a fancy W-3 here. W-3. W-3. Total wages were this much for federal, but some people among that 340,000 earned more than 128,400. So it's a slightly different number than the 343. Total wages were 343. Wages eligible for Social Security was only 340 because somebody or some people went over 128.4. Notice that the Medicare number is always going to be the same as the wages. So this is just a summary of all of the W-2s. Here you go. This is more of a personnel thing. You must document each person's authorized to work in the United States. And you don't file this with any agency, but you have to have this record on hand in case there's a challenge, okay? Must be retained by the employer and made available for inspection if requested by the Department of Homeland Security or the Department of Labor. Okay, we're finishing up, I think, now. Workers' compensation. Let's talk about that. Workers' comp. You've heard the expression workers' comp. Oh, so-and-so got hurt and he's collecting workers' comp. Workers' compensation is an insurance policy that companies are required to carry, depending on the state. And it's based on your experience in terms of injuries. Just like you could control your state unemployment tax by having a consistent, steady, long-term set of employees, you can make an attempt to control your workers' comp insurance because it's always going to be based on your experience. So this is an insurance policy for employees who suffer a work-related illness or injury. It is paid 100% by the company. The employee does not pay workers' comp insurance. They get the benefit of it. It's the employer who must pay it. That's required in most states, except I guess in some red states. We'll leave that comment aside. The employer pays the entire cost. And it's going to depend on the number of employees, riskiness of the job, and most importantly, the company's accident history. So the rate for commercial fishermen compared to an office worker is going to be much higher. That's a rather dangerous job. I mean, if you're working on as an underwater demolition explosives installer, and I'm working as a CPA, the chances of me blowing myself up are not as great as yours are. So therefore, that company who employs the demolition guy is going to pay a lot of workers' comp insurance. And again, it's controllable. It's controllable. You're going to have accidents in your workforce, you can control this. That's why companies consistently stress safety. They have safety training quite a lot at most companies. They make sure employees know the importance of keeping the aisles clear, clean up spills, that type of thing. It can save a lot of money. And normally you pay it at the beginning of the year based on an estimated payroll. A year-end adjustment is made. In other words, you're guessing at it. You're guessing at it. Sort of like bad debt expense, if you remember from chapter 6. What will our insurance contribution premiums be? Well, you expect the payroll for next year to be $210,000. Your current rate is 0.2%. That's 0.002, very tiny number. So multiplying them out, and we think next year we're going to have insurance expense of $420. So we debit the expense and we credit cash. I think you could also say we're going to debit prepaid workers' comp, and then smooth it out over the year like we do with prepaid other insurance. But the point is, this expense is recorded at the beginning of the year on our best estimate. Now the year ended, and we were off by $20. Good gosh, we're off by $20. All that means is we owe the government or the insurance provider, whoever it is, $20 more. We owe Cigna $20 more. So we just increase the expense and the liability. That's all there is to workers' comp. It's a very controllable item, though. And now they're just showing you if it goes the other way. Here we estimated 410. I'm sorry, we estimated 420. We estimated 420. Turned out to be just 410. So we don't have a payable. We have a nice receivable of $10 coming. Okay. Well, I think that, as you probably just saw by accident, we're kind of done with this slideshow. This is the last chapter that I'll be lecturing. Next Monday is not your exam. Next Monday can be a very, very good exam review, if you will. You know what chapters are on this exam. Looks like on this exam, it's going to be 7, 8, 9, and we go from there. So I hope to see some of you next week. Too bad we didn't get anybody here today, but that's okay. I understand why you don't show up all the times. I've heard it. I've often gotten this compliment from people. They say a minute with Bob is like an hour with somebody else. So I think that's why we got limited attendance here. We're like the St. Louis Browns of 1936. Anyway, take care, everybody, and I sure hope to see you on Monday. Good luck. Bye-bye.